What's going on, guys? Here it is John doing a video on investing. Here we are. It is February and we are having some red days, some big red days in the stock market. I'm doing a quick video here today, and it is basically, at the time of this recording, it is March 4th. And I did another video recently on the way that the markets are correcting and such, and really kind of studying some of the history of really when the bear markets ended and where kind of some of the bull markets peaked, right, going all the way back to 2000. And it's very interesting that it all happens in March. I think, obviously, I don't know why it all happens in March, but it just is very clear that it does, right? And one could conclude maybe that it has something to do with the fact that corporate taxes are due. The deadline traditionally has been March 15th, so that might have some sort of a connection with that, right? But basically, I have another video that I did recently. I'm going to go ahead and put a link in it in this description area where I cover all of the events, right, that happened in the month of March. And what it was in March 10th of 2000. That was when the NASDAQ peaked, right? And then it was, pretty much the dot-com crash, which was, really a stock market, very slow over time crash where stocks went down, certainly a lot during the month of March, but then also a lot from March 10th, which again was the NASDAQ peak, March 10th of 2000, all the way until October of 2002. So that's a solid, 1.5 years of the stocks going down. Then we have 2009, which was March 9th, right? And March 9th was the marks basically the bottom of the bear market, which that started then in October of 2007. And currently where we're at right now, again, the time of this recording, it is Thursday, March 4th, and we are in a bull market since literally 2009. So since that bottom of the bear market, which was March 9th of 2009, we are in the bull market. But we certainly had a lot of red days, a lot of correcting in terms of some of the growth stocks in February and March as well. So here we are Thursday. It's been 4 trading days so far this week, and Monday was a big green day for a lot of the stocks and certainly the growth tech stocks. And then here we are. We've got three days in a row of some pretty big red days. So what we're doing is I'm breaking out a recent video from Tom Lee, and really have enjoyed listening to Tom Lee, as a lot of people have as well, in the way that he is so bullish on equities and really backs up a lot of his forecasting, right, on a lot of very, very very specific research, in terms of understanding the cash that are on the sidelines and understanding a lot of what's going on in the markets and how much everybody's investing into equities versus bonds, and forming some very valuable guidance. In fact, he was spot on with everything with respect to his targets for the S&P 500 in 2020 and where it was going to go in April and then where it was going to go in August. And I've actually got another video for that, so I'm going to put that one in the description area as well. But here, I think it's definitely good when there's some red days. It's really good to kind of sit back and reflect on, what the positive aspect of it is. And if you do have some dry powder, which I've actually been talking and highlighting about the reality that there could be, certainly could be, what is a correction and a pullback from some point in February to April. And obviously here we are on March 4th and we're seeing that. So it's really good to have some dry powder, and it's really sensible to consider, really trimming that margin, because, if you got your price investments and you've got your margin, those price investments are going to go down, let's say 5%, and then you've got your margin, then your net equity is going to actually be affected by that much more. That works on the upside, but it's certainly very damaging on the downside, because if you have too much margin, you can then, of course, have some of your, have what's called a margin call. So basically, you certainly should have some dry powder in between February and March. And what I mean by that, of course, is some cash there available to tackle some opportunities, some stocks that you've been looking at that you wanted to buy but maybe couldn't buy because they just keep going higher and higher. Well, guess what? They're going lower and lower. So it's a good time to think about what price or what time you want to get in. So, hey everybody! Before I go in there, I'm going to go ahead and open up this interview with Tom. Go ahead and, if you can, hit that like button, hit subscribe if you find any value from what I'm saying and what I'm doing here. Go ahead and hit that subscribe or ask a question in the comments area. Everybody, I've been investing since 1989. I've done very well with it. I've got another video where I show you my performance going summer 2017 all the way through September 2020. And I have basically done 3x plus better than the S&P 500, and I go through all of my percentages there, and yeah, so I'm going to just keep providing you value in these videos, and hopefully you find value in that value and some of those tips, and if I can provide anything else, just let me know. So let's go ahead and hop in here and see what Tom has to say.
Advisors and a CNBC contributor. Tom, always good to see you. You have said the tech trade is done. Is that what, in fact, we are witnessing right now?
Yeah, I think tech's leadership, which was so astounding for the past decade, I think we're seeing a new leadership emerge. And I think that's one of the things that is sort of central to our thinking is what is the market telling us? And the leadership of energy and the financials and cyclicals to us is really telling us a vigorous economic recovery is underway. These cyclicals could turn into growth stocks, which means traditional growth stocks aren't as shiny and as interesting.
Does that necessarily mean, I mean, Tom, if you believe in all of these sort of growthy, cyclical, not growthy, but leverage to the growth story, I should say, names are going to go higher, and that's where the leadership is. Does that necessarily mean that inflation will, in fact, go higher as well, and so will bond yields?
Well, I think we're struggling with what that means, and I think the market is, because inflation has essentially been eradicated from the market's thinking for the last 12 years. And I think that's why there's this hypersensitivity to both rates
12-year bull market
and inflation expectations. But I think the Fed's been pretty clear. If energy rises or commodity prices surge and it causes CPI to rise, that's not really inflation. It'll show up in CPI. But what they're worried about really is a change in how people's inflation expectations are anchored. I think that's going to take quite a lot of time. So I think you have a period where the economy could run really hot. That's why the cyclicals are rallying. But it's not something that's going to force the Fed's hand. And I know the bond market's been testing the Fed, but that's really the question. It's a key question.
So, Tom, I'm in your camp. I've been playing the value trade as well. Are you playing? What I've been doing is playing European levered value plays, especially in the chemical space. Europe has lagged, and they have a bigger leverage towards a reopening trade because they're based more on tourism than we are. Are you thinking about that dynamic?
Europe's interesting because it has lagged. We did a little global sort of look around for our clients yesterday, and the leadership for equities has come out of China, Korea, and Japan. Those have really led the turn. And then we're starting to see like Chile and then U.S. cyclicals sort of start to participate. So to me, it feels like domestic cyclicals are really early in turning up, and they're not extended. But eventually, I agree. I think then it would lead to European financials starting to rally because they're the epicenter of the value trade within Europe.
Tom, it's Karen. Let me ask you something. If you think this rotation is really happening and tech is going to be sort of somewhat of an anchor on the market, do you think the market as a whole will rise?
Yeah, it's a dilemma. Tech and growth is 67% or 2/3 of the market cap, and it's really what builds careers for most institutional investors. So growth stocks are really what the professional money manager trades and understands. I think there's a chance that growth just does okay. Jeff DeGraff mentioned that because there's money flowing into the market. But for someone to have beat the market, outperform, it's really that 23% or 30% cyclical exposure that's going to do it. And of course, energy is an example. Energy's up 30% this year. I would say out of our entire client base, maybe 5% have dabbled in energy. Most have actually essentially zero weight in the energy sector. Most think it's just an annoying little group that's risen.
Tom, it's interesting that consensus is now that the economy is going to come roaring back. And so, I want to go to the contrarian thinking on this, and that would be so many states are lifting their restrictions now. And while President Biden moved up the timeline on getting U.S. adults vaccinated to the end of May, there's still that critical time period, and the variants are still out there. Is that a possible sort of caveat to this whole forecast of yours?
Yeah, I mean, COVID's unpredictable. It's super dangerous. The variants are out there. So nobody can say COVID's been vanquished. But if you look at a state like Florida, that's been open, really relatively open for a while, their economy has actually been quite booming. And then if you look at states like North Dakota and South Dakota, where the prevalence of COVID plus the amount of vaccinations is over 60%, they've seen a 95% drop in cases. I mean, South Dakota now has like less than 100 per day. And so those economies, as they open, also have what appears to be a lot less risk. So I might say that the contrarian view would be people aren't bullish enough about the reopening, because this is really like a post-war reconstruction period with government stimulus. That is extremely boomy for real investment spending, which is the biggest multiplier to GDP.
Wow. Tom, always great to get your thoughts. Thank you.
Yeah, thanks.
Tom Lee of Fundstrat. Wow, people might not be bullish enough, Grasso, which says to me inflation, inflation, inflation. I don't know about you.
It does, and if you look at, we talked about spend.
So there you go. That's Tom. Don't need to see as much of what the other folks there, what the other cats have to say. But in case you aren't aware of what he means by cyclical stocks, so just to give you a little definition here, cyclical stock is basically involve companies that sell consumer discretionary items that consumers buy during a booming economy but spend less on in a recession. It's like restaurants and airlines and all those sorts of companies. But basically, and then obviously he talks a lot about energy and utilities. So so basically, very, very interesting there from Tom on what's happening with growth, and he kind of sounds like he's says it's going to pretty much flatline out there, and then energy and cyclicals and utilities are going to outperform. But it sounds like even their clients are really not really that focused on energy, but certainly something to take a look at. So hopefully those. That interview and those some of that information is encouraging for everybody. It's very very bullish. He's very bullish on the way that the recovery is going to be and how the recovery is going to affect the economy there. So hopefully you enjoyed that. And everybody, hey, I just came out of the blueprint. If you want to check it out, I cover investing, I cover online income, I cover credit, business credit, financial independence, and also have a guide at the end, which is all the groups in the U.S. that offer a free credit score, and all the groups that offer you a free FICO and the corresponding bureau with that FICO, and then it covers all three bureaus: Equifax, Experian, and TransUnion, so you never have to pay for a free FICO again, or at least as long as I keep updating the guide there. Anyway, so that link is going to be below as well. Have a great week, and let me know your thoughts on what's happening right now in March. Thanks.